Welcome to Catching Up to Real Estate. I'm Charlene Lewis, and I got my producer Anna here with me, who, by the way, ain't even in real estate. So if you've ever felt lost in all the market talk, trust me, you're not alone. We're breaking it all down: buying, selling, investing, and even how real estate pops up in culture. And just so we're clear, we're talking Washington State real estate. So if you're trying to make moves here or just make sense of the market, we got you. Let's catch up to real estate. Tap in. Talo Falava. My name is Charlene Lewis, and this is my podcast, Catching Up to Real Estate. This is our third episode today on April 9th, 2025. If you haven't already checked out the other episodes, we normally go over statistics in Washington State regarding real estate, hopefully to help everybody around here catch up to real estate in this state. So first off, it is the end of the first quarter, so we will go over the statistics that show the market is in a balancing act. And secondly, what does new construction statistics versus used property statistics show us? What does it actually tell us? And thirdly, tariffs. So going into the first quarter, and if we're going over the statistics for each county to break it down so that it will show you what exactly the market is doing. Currently, overall, there's more inventory being added to the market, and there's slightly more sales. So if we look into Pierce and Thurston County, it's showing a fair market exchange. It's not increasing exponentially, and the cost of houses dangle around $500,000 up to, a little bit short of $600,000. But in King County, that median sales price is sitting at teeter-tottering between $960,000 up to $1 million. Last month in March, it was sitting at $1 million for a median sales price. It has now dropped down to $999,000. Not much difference. But what's still consistent in King County is that there are more cash buyers than those that are using finance. And so in Pierce County, every fifth offer is a cash offer. In King County, it's every third offer is a cash offer. So there's more cash purchasers, cash buyers in King County, which shows also in the statistics when we show you on here. It's really busy. It's very competitive. There's more pre-listing, pre-inspections going on listings right now in King County than there are in Pierce and Thurston County. And that is also from my own experience on the transactions that I'm working with currently. So that's a little bit about how the market is showing you that it's in a balancing phase. At the beginning of last year, we had 1.5 months of inventory. Currently, right now, we are at 2.13 months of inventory. So there is an increase. A healthy market is 4 to 6 months. So we're going to continue to climb at this rate. But the increase in sales has only increased by 5% overall the entire Northwest MLS in Washington State. So to me, that tells me that we're slowly growing. We're adding more inventory. But, that also means a few different things for some people. As far as looking at new construction statistics and looking at used property statistics, currently right now, median sales price for a new construction is $460,000. Comparing that to median sales price of a used property, similar type, a single family home, is at $650,000. So if you're going to buy new, you're going to probably pay $100,000 more than the same property that's already been used by somebody else or has been repaired or, flipped and whatnot, about $100,000 more on new construction versus a used property. So you may benefit as a buyer if you purchased property that is not new construction, at least for the value and the cost of things. And thirdly, on this episode, we are going to talk about tariffs. How is that going to affect real estate? I mean, I'm sure we're all expecting it to, considering the stock market has definitely decreased recently. It has definitely gone down. But I mean, I believe in the market. I believe in the United States. So I know that it is definitely hard right now for most people, but be patient. I can only hope that we can actually gain from the future the potential that it's going to grow back to where it was once. Okay. And that's the hope. For my own personal opinion, it might shift as far as who you want to invest with in the future. Okay. Now, as far as how tariffs are going to affect real estate, I think we can all agree it's going to be more expensive to build a brand new property. That also means that people who are investors will have, if we continue to increase inventory as we've been discussing this episode, right? If it continues to increase because more people are putting their house on the market, but there's not that many buyers, and if these interest rates, because mortgage rates have dropped down a little bit by maybe a half point. So remember the last statistics I told you guys, one decrease in interest rate usually frees up about 5 million buyers, right? Well, we've only dropped down about a half point in mortgage rates. Now, because of the tariffs that are going on, that's going to affect it as well, because that means the cost of the home is going to be exponentially high for a new construction, and a used property to repair it, it's also going to cost more money to repair that property. So there may be less buyers in the future, even though interest rates are going to drop. Now, there is a rumor, politically speaking, that, we are going to ask Jerome Powell to drop the federal funds rate right now because of what is going on, but it's just a rumor. There's a 75% chance that they are going to drop interest rates next in the next meeting, but it's 75%. I feel like it's leaning towards it's not going to be increased because there's too much uncertainty in the economy and the market. So in order for us to be level-headed, we have to take our time dropping that interest rate. And I could agree with Jerome Powell on that. So, but for me, if the inventory continues to grow and the sales can slowly climb, then, like I said before, it would technically be more people who can buy cash and who can afford to purchase property are going to be the ones who are going to buy the inventory up if they can afford it. And you can normally understand that not just one person can purchase those properties. An investment trust could do that. There's a couple of rent-to-own programs that are, that are around. They may actually start purchasing here shortly. But it all depends what happens in the next month or two in the economy. So these tariffs are a big thing. It's going to affect all of us in different manners, in different ways. So be careful out there. That's all I have to share on that point. But okay, let's go on to the next segment of our episode, which is questions from either a buyer, seller, or an investor. And before we go into this segment, I just want to add the potential dangers of tariffs, right? If we try to figure out if there is light at the end of the tunnel, because what I see is that real estate is just going to be more expensive. It's just going to continue to grow. There's not going to be enough, homeowners purchasing their first home. They're going to work really, really hard to get there. So the only shade of light that I can give you is you have to fight for more income, fight for more jobs, and that is your savior at this point. Is we're going to have to figure out ways to make more money, guys. That's really what's going to save us. But anyway, going into our questions segment, we have a couple questions from a buyer, seller, and an investor. for a buyer, how much should I save for a down payment? Well, it all depends on a few things, okay? You're going to have to pay for your closing costs, which usually run about 2 to 3% of your purchase price. You're going to also have to save up for your earnest money deposit. The unspoken rule is 1% of the purchase price. So if you want to buy a house that's $500,000, then you should probably put bare minimum of earnest money deposit, $5,000, okay? That is due from the beginning of the transaction. Your closing costs is due at closing, okay? Your appraisal is dependent on the lender. It can be tied into your loan, or it could just be paid up front, or it is due at closing through escrow. And so that runs you about anywhere between $600 to $1,200, depending on the appraisal and the property. The inspection here in Washington State, my clients have spent about $350 to $500 for an inspection these last 12 months. So, and then the last portion is your down payment for the actual loan, right? So if you're using an FHA loan, you're only required to put down 3.5% bare minimum, okay? An FHA loan is not a first-time home buyer loan. It just means a Federal Housing Authority loan. It is the only loan that allows you to put minimum down, and the qualifications are a little bit lenient. A USDA loan requires zero money down, but that's not including the costs of, your closing costs, your earnest money deposit, your inspection, your appraisal. That doesn't include in a USDA loan cost there. So that's all separate. If you use a conventional loan, you're going to have at least bare minimum 5% of the purchase price. So if you're asking me how much should I save up for my down payment of a home, well, we should probably calculate what you qualify for first, and then identify what you actually want to pay a month. And then from there, you'll know exactly what your threshold of what percentage of what you're going to base it off of that purchase price, okay? So if your lender says that, oh, you could qualify for $800,000 of a house, don't stick to that number to go find a house. What I need you to do is figure out what payment plan you're willing to pay every single month for the rest of your life. That's what you want to focus on. What's your monthly payment? And then if that monthly payment is $2,500, then you probably have to, have a lot of money down on a $500,000 house. A $500,000 house right now in Washington State with a 6.5 interest rate, that mortgage costs with, bare minimums, if we're looking at an FHA loan, you are going to need, if you don't put that much money down, 3.5%, and it's only a $500,000 house, that is $15,000, $17,500 on that. You're also going to need closing costs, which is about almost 3%. So that's another, $12,000. So add that on top of that. The earnest money deposit is from this same pool, by the way, but you want to make sure it's accessible when you're putting in offers on houses. That way, if they accept your offer, you have the money ready, okay? Your inspection is not going to be due right then and there, but tracking back to what we were just discussing, if it's a $500,000 house, we're looking at down payment, closing costs, inspection and the appraisal. Those, and then all the other costs of you moving your current home, into this new home. So you have to figure out how much it's going to cost. So at the end of the day, a good cushion here in Washington State for a $500,000 house, in order for you to get a monthly payment of $2,500, you're probably going to have to save about $75,000 to $100,000 to get a $2,500 payment a month. So yeah. Anyway, so second question is tax implications when you're selling your house as a seller, right? So we're going to be discussing capital gains. When you sell your house, you're going to have to figure out how much you bought it first. How much did you buy the house for? And then how much are you about to sell it for? If you, as a single person, get a profit of over $250,000, you will have to pay capital gains on that profit. If you are married, filing jointly, then that profit has to be $500,000 or more in order for you to have to pay capital gains tax. That's only in Washington state. And the amount is always dependent on your overall income or your gross income. So everybody's situation is different. So I can't technically tell you what percentage that capital gains is supposed to be. Okay. It depends on your overall income. And then you're also going to have to pay an excise tax, which is basically the tax on the sale of the property. And then you're also going to have to pay attention to your property taxes. Now, the great thing about property taxes, it used to be that you can utilize the money that you pay towards your property taxes as a deduction on your taxes. However, the current tax law states that it's only applicable if your deductions are more than the standard deduction for your filing status. So if you're a single filer this year and you had property taxes and all the other deductions that you have equate more than your standard deduction for a single filer, which is, I think this year, $14,825. So if it's more than that, then you can utilize it. If it isn't, then there's no actual positive to report your property taxes. But as far as like selling your property, the biggest thing that you're probably paying attention to is your capital gains. And the sales tax is not even that expensive. It's like a couple thousand. So, that's the only thing. It's not actually deductible neither. But at the end of the day, if you're asking what tax implications are you going to pay attention to for selling your property, your capital gains is the number one thing. So just identify how much you bought it for, what you sold it for. If it's more than the thresholds I advised you on, then you're probably going to have to pay capital gains tax on that. If you're going to ask me what that rate is again, I'm going to tell you again, refer to how much your total overall income is, and then we can discuss how the actual formula is in order for you to figure out what your capital gains is. So reach out to me, call me. You have the number. So the last question is from an investor, and the question is, what are the risks of real estate investing? In residential versus commercial. So the risks that you have in doing residential investing, your risk is basically you're not really sure if every single renter is going to stay there, right? You're going to look for tenant longevity, dependability too, because these days it's hard for everybody. So you may not actually get the fair market rent that you want for the perfect tenant. Excuse me. You may not get a consistent renter. That's a risk. So you might have to make sure you have a cushion to be able to pay your mortgage if you have a mortgage on your rental. Because your renter might be late on 1 month, or they might not even pay for a whole 3 months. So that's the biggest risk, in my opinion, that you have residential. Also, that same tenant might not take care of your property, so they could damage the property, and you're going to have to come out of pocket to pay for that damage in order for you to continue to have your, property. Now, also the other risk of residential is that, which is what most people are afraid of right now, is maybe the market crashes, right? And now you're still paying a very high mortgage, but the property is valued below than what you purchased it for. So, that's a risk that we endured in 2008. But right now, I'm not really sure most investors would be enduring that issue because I see hyperinflation coming. So, as far as commercial, the risks of real estate investing in commercial. Well, I'm sure you guys have all heard the rumors. Commercial's not doing so well right now. And that might be because a lot of people are working from home. Now, there has been a large push here in Washington for, Amazon and all these other big conglomerates downtown to have their employees come back to the office, and which has actually caused a lot more traffic going on. And so the risks for commercial real estate is tenancy, just like, residential, but it's a different calculation. So for residential, most investors account for the property being empty for, maybe 5% of the time. But with commercial, there's not an actual structure for it. It depends on who you gave tenancy to. It depends on who you gave tenancy to, and it depends on the type of building or type of, business that is being functioned in that commercial space. So to me, I think commercial, the low risks in commercial involve wholesaling the property to somebody else. Those are low risks, but high risks in commercial have to do with big strip malls. Basically, when you have more tenants, that means you're going to have to deal with more issues, which means you probably have a big building, more square footage, more costs in keeping those, keeping that square footage intact. And then also property taxes. I mean, there's so many risks in commercial, but if you have good connections and you have good people, just like residential, only at a higher level and scale, you can definitely also gain the most in commercial. So they're somewhat similar as far as their risks, but the amount of risk or percentage of risk, there's a lot more involved in commercial than there is in residential. So I always recommend people, because more people, everybody's going to need a house to live in. But commercial businesses these days start functioning out of their own houses, online, warehouses. And some of those warehouses right now, I'm actually, in a shared space as a co-working space. These are starting to be more prevalent in this current state in commercial. A lot more people are, renting out a desk within a bigger building so they can have access to other amenities that the building can offer. But for them, it's a smaller cost for their business. And that's what I did myself as well. So because I'm also doing the same thing, I know other people are also doing it because I witness it. I see it right here. So those are the risks in residential and commercial real estate investing. But today, this concludes our third episode. And I thank you guys so much for paying attention. It has been great. It has been lovely. I hope that the information I've brought to you today enlightens you and it helps you catch up to real estate in Washington State. I'm your host, Charlene Lewis, signing off. Have a good one.